How are things now? My name is Paddy, and welcome to the 12th episode of my podcast, Defining Cashflow. On this episode, I want to discuss the in carry trade, and this is a topic I've been wanting to cover for a little while now. But in all honesty, the in carry trade and any topic at all related to economics and finances feels fairly unimportant to me in recent weeks, now that our news has become consumed with the news of the latest war that the world now finds itself in. And this war has only been escalating from the start, and now it's become economic warfare as well. And despite the war being so tied in with global macroeconomics, and usually I'd follow macroeconomics for hours every day, but I've been trying to look at a lot less news in recent weeks. And I think this is really for the benefit of my mental health, because the news can be very depressing. It can make us angry, and anger can be a lot harder to sit with than depression is, and it can make us feel completely helpless. And one of the only things that we can do, and in keeping with the main topics of this podcast, which are macroeconomics, one of the only things we can do, which once again doesn't feel very important to me right now, but one of the things we can do is we can manage our portfolio and manage the risks that we are exposed to. And part of me would have liked to have done an episode on the economic impacts of this war at the very start, because I think the markets have been completely unaware of how to react to this war. The S&P 500 was higher at the end of the first trading day after the war started than it was at the end of the trading day before the war started. And, despite people saying that the markets predict the future and that most things are already priced in and the markets know more than any of us individually, well, I think that's complete bullshit. Half of the market is passively managed, meaning that it's managed by nobody at all. And the other half of the market is mainly managed by people who are monetarily incentivized to tell you that now is a great time to be in the market. And this is why I think markets are always blindsided by market crashes. But onto the topic of today's episode, and let's discuss the yen carry trade. And this is something I've wanted to discuss ever since about August 2024, which is when the yen carry trade made its way into our news headlines for the first time. And I'll explain a little later on in this episode why it was August of 2024 that the yen carry trade first became big news on our financial news. But the yen carry trade essentially is built upon a strategy where an investor would borrow money at a low interest rate, and then they would take that money and invest it and hope to make a larger rate of return on their invested money than the interest rate that they're paying on that money as they're borrowing it. And the idea is that you make a profit on that spread. You make a profit based on the difference in the rate of return of your invested money versus the interest rate that you're paying on the money that you borrowed. Banks too use this strategy to make money. A bank will pay you an interest rate on the savings that you deposit at a bank, and then the bank will take that money and loan it out to someone who's looking to borrow that money, and the bank will charge that person a higher interest rate in order to borrow that money. But the banks are in more control when they utilize this strategy, because the banks can adjust the rate at which they loan money out. If, for example, the Federal Reserve was to raise interest rates, which would force the bank to pay out extra money on the savings that people have deposited at the bank. But the same level of control doesn't exist for participants in the yen carry trade, however, because those investors can't determine the rate of return they make on the money that they've invested. And also, those investors can find themselves in a situation where the interest rate on the money that they're borrowing also increases, which is something that's outside of their control. So let's now look at why this strategy has become very popular in Japan in particular. Well, if we were to look at a chart of the Japan 10-year Treasury yield, we can see that rates in Japan have been very low for quite some time now. In fact, the Japan 10-year Treasury yield has been below 2% for the vast majority of the last 3 decades, and it's been below 1% for the majority of the last 1 decade. If we look at the left-hand side of the screen, we can see that rates in Japan were much higher in 1990. But then Japan experienced one of the biggest equity and real estate bubble bursts in modern history, a crash from which Japan never really fully recovered. In these charts, we are looking at the Japan 10-year Treasury yield and the US 10-year Treasury yield side by side, and we can see that the overall trend in rates in Japan and the US were quite similar over the last number of decades, with rates in both countries starting around 8% in the year 1990 and being on a downward trajectory from 1990 until the year 2020. But rates in Japan fell much more quickly and have remained substantially lower than rates in the US for the majority of the time over those last 4 decades. And we can see this more clearly when we look at these two graphs where we look at the Japan and US 10-year Treasury yield over the past decade. And as we mentioned already, rates in Japan fell below 1% for the majority of the last decade and even found themselves in negative territory. But now if we look at the Japanese and US Treasury markets over the last 5 years, we can see that Japanese rates have surged higher over the last few years, while rates in the US have remained range-bound over the same period of time, with rates in the US having peaked 2.5 years ago in October of 2023. So now we can see that the spread between US rates and Japanese rates are being squeezed. And it is this spread that investors in the yen carry trade were depending upon in order to make their money. Because a lot of the money that was borrowed in Japan to invest abroad was invested in US treasuries. Essentially, money was being borrowed in Japan to invest in America to continue to finance the US government's deficit spending. But if we were to overlay both of these charts on top of each other, we can see that there's a long way to go before this spread really begins to close. And for that reason, investors who borrowed money in Japan to invest in US treasuries may not need to panic too much at this point. But US treasuries hasn't been the only place that these participants of the yen carry trade have been investing their money. Another very popular investment for all this money that's been borrowed in Japan has been in US equities. And as we can see from this chart, US equities, and in this case the S&P 500, is now negative on the year. In fact, the S&P 500 is now lower than where it was 6 months ago. And as I've covered in my previous episode as well as others, I'm still very concerned regarding my outlook for US equities and specifically the S&P 500. As we covered in episode 3, the S&P 500 is now at its second highest valuation of all times in accordance with the CAPE ratio. And when I take this into consideration, as well as considering where I believe we are in this current credit cycle, I'm very concerned that there may be a substantial correction or a substantial crash in store for the S&P 500. If we were to consider the S&P 500 were to lose 50% of its value, as an example. Now, I know this doesn't seem very practical or realistic at this point in time, but that's exactly what happened to the S&P 500 at the end of previous short-term debt cycles, such as in 2001 when we had the dot-com bubble burst, and in 2008 when we had the great financial crisis. But even if we didn't have a huge correction in the S&P 500, let's just say if the S&P 500 were to lose 10 or 20% of its value, well, what that means for the participants in the yen carry trade is that the money that they've invested is now lost 10 or 20%, but they still owe 100% of the money that they've borrowed. In fact, they owe more than 100% of the money that they've borrowed because they also owe interest on that borrowed money. But the differential in interest rates between Japanese yields and US yields isn't the only factor that's affecting the participants of the yen carry trade. Because these participants borrowed money in yen and then invested in assets denominated in US dollars, the relative strength of the currencies has a huge effect on the participants of this trade also. So let's now look at a chart of the US dollar versus the Japanese yen. And we can see that the yen has been strengthening against the dollar between 1980 and 2012, with each US dollar being worth substantially less yen in 2012 than it was in 1980. But then in 2012, this trend reversed, and the US dollar has been strengthening against the yen ever since. And a stronger US dollar or weaker yen helps the investors in the yen carry trade. You would want the currency in which your assets that you hold are denominated in to be strengthening, therefore increasing the rate of return that you're making on those overseas investments. Likewise, you would want the currency in which you're borrowing, the yen, to be weakening, which makes it easier for you to pay back your debt. It makes it easier for you to pay back the yen that you had borrowed. And if we look at a chart of the US dollar versus the yen over the last few years, we can see just how significantly the dollar has strengthened compared to the yen over this time. And once again, this massively helps the participants of the yen carry trade, and it has no doubt increased the popularity of the trade also. There has been a few hiccups along the way, and when we look at the times over the last few years where the yen has strengthened against the dollar, we can see that in August of 2024, when the yen suddenly strengthened against the dollar, that this coincided with a 10% drop in the S&P 500. It is at this time that we would heard the yen carry trade making news headlines for the first time. Then, in February of last year, the yen strengthened against the dollar once again, and this once again coincided with a downturn in the S&P 500. The main drop in the S&P 500 at this time, though, happened in April due to the Trump tariffs. And I bet that Trump loves the fact that he can move markets more than something as substantial in macroeconomics as the yen carry trade. So, do I believe that an unwinding of the yen carry trade might cause the next stock market crash? Well, the answer to that is no. That's absolutely not what I'm saying here. But I do believe that if we were to have a market correction or a market crash, that the inevitable unwinding of the yen carry trade that would happen in that scenario would absolutely exacerbate the problem. And once again, the main reason I'm worried about US equities and specifically the S&P 500 is my belief that we are in the midst of an AI bubble right now. I'm a huge believer in AI. I use the technology a lot, and I believe that it'll change our economy and our world in completely irreversible ways, just like previous technologies have, such as the invention of the canals and the invention of the railroads and the invention of the car and the invention of the internet. These technologies were so revolutionary that they completely changed our economy in ways that were never reversed. But people got so excited about these technologies that they caused equity bubbles in the short term, bubbles which eventually ended up popping. To quote Warren Buffett, when the tide goes down, you can see who's swimming naked. But I don't think it's the tide going up and down that we need to focus on. I think the thing that we need to focus on when we zoom out is interest rates. And if I were to go back to the chart that I've used all throughout my episodes that best describes where I believe we are in this economic cycle, it is this chart here where we're looking at the overnight rate or the Fed funds rate by the US Federal Reserve. And we can see clearly in this chart that it's after a period of time where we've had an interest rate hiking cycle that we encounter a recession. Its rates going up is the equivalent of Warren Buffett's tide going down. That's when we see who's swimming naked. And with regards to who may be swimming naked, we've heard a lot about private credit in the financial news over the last few weeks. And I think this is going to be something that's making huge headlines in months to come. So I'll dedicate the next episode of this podcast to private credit. And if you'd like to continue following along as we follow the main themes in our global macroeconomy as well as our local Canadian economy, please like and subscribe. And we'll see you all again soon, hopefully.